Hello, everyone. Welcome back to another Lunch and Learn webinar. I'm your host, Mayur Thaker. I'm an equity strategist here at Zacks Investment Research, and this is an update to an existing video series that I've been maintaining called The Little Screen That Beats the Market. So let's take a look at what this exactly is if you're not yet familiar. In Q1 of 2023, I made a video titled The Little Screen That Beats the Market. You can get this from our YouTube channel. Just go to YouTube and type in Zacks Pro, search for that. That is our YouTube channel where all of these videos are, uploaded. And you can search for this title, The Little Screen That Beats the Market. That's the original one that I made just over 3 years ago, back in 2023. So actually almost 3 years ago, not quite. And I made an update to that earlier this year, about 6 months ago, back in May of 2025. That just talks a little bit about performance. So what I decided to do recently is kind of revisit this twice a year. So this is the semi-annual update to that video with updated commentary and performance figures. So let's get started. So just a quick background, if you're not familiar, companies with high growth and high return on invested capital outperform similar high growth companies with lower ROIC. This is because high ROIC means that the company is generating more free cash flow, which then gives the company additional options that are not available to the low ROIC business. And these options include things like debt paydown, strategic M&A, share buybacks, or just a greater ability to reinvest the capital back into the business. So let's take an example of two companies, and we're going to look at exactly the impact that ROIC has on two hypothetical companies growing at exactly the same rate. So we know, we hear about growth all the time. A lot of, investors, rightfully so, emphasize growth. So let's take a look at why ROIC is the dark horse in investment analysis and management. Let's take two companies as an example. They're both compounding at 10%, right? They're both growing earnings at 10%. So we have XYZ Corporation and ABC Corporation. Let's say starting at year zero, they're making $1 of net income. Don't even think about per share or anything like that because you can't really compare two different companies on a per share basis, right? So let's just say this $1 references $1 of net income, not earnings per share. That way it makes two businesses identical in comparison. And let's say they both compound at 10%. So in year zero, it starts at $1 of net income that grows to $1.10. And you can see every single year, the two companies compound at 10%. So by year five, they will be earning net income of $1.61. They're both identical, right? Now let's take a look at the capital base. This is where, most investors fail. Most investors do not talk about this, do not look at this, do not think about this. But the capital base is the base of capital, right? That the company had to invest in order to produce these earnings in the first place, right? Where do earnings come from, right? They come from revenue. Where do revenue come from? Well, they come from assets. That is your capital base, right? Your assets are the capital that needs to be invested into property, into equipment, into tooling, into factories, into office space, into computers, into servers, right? All these things that we know are assets of a business. So let's say the capital base for each company starts off at $10, right? $10 of capital base, meaning that's $10 of property that each company deployed into their own business in order for it to generate these earnings in the first place. So XYZ starts at $10, then the next year that grows to $11. The year after that, $11.99. The year after that, $12.95. I'm just throwing out different numbers here, right? Don't worry about the growth rates or why it goes from, 10 to 11, from 11 to 11.99. Let's just say that that was what the cost of doing business was for each year for each of these two companies. For ABC, it goes from 10 to 11, from 11 to 12.10, from 12.10 to 3.31. And so you can see that by year five, ABC, just due to the nature of their business and the way that they run things, they had to invest $16.11 by year five. And that's a cumulative number, right? It's a cumulative number. XYZ went from $10 to 14.69. Again, the normal course of doing business means that costs increase. You have to update your factories. You have to reinvest capital to keep things running smoothly. When, some tool breaks down or when a computer breaks down or gets obsolete, you have to replace it. So all that costs additional capital, right? So every time, every single year, companies do have to reinvest some of these earnings back into themselves to stay, atop, to stay abreast of the latest and greatest technology and the latest and greatest manufacturing methods and equipment, things like that. So XYZ grows to 14.69, ABC grows their capital base to 16.11. So that's where ROIC comes in. ROIC looks at the return, which is the numerator of this equation, which is earnings, or net income, I should say, divided by the capital base. Oops, let me go back there for a second. So in year zero, XYZ and ABC were both earning $1, and both companies had $10 of invested capital, meaning $10 that they had to invest into their company to get started. That means that they have an ROIC of 10%, right? $1 divided by 10 gives you 10%. But look at the separation that happens over the course of 5 years. By year five, again, both companies had the same net income, $1.61. But look at the difference, right? We had a little bit of a difference in the capital base. XYZ really didn't need to invest as much money as ABC did. And so XYZ's ROIC was 11% by year five, whereas ABC's ROIC stayed fixed at 10%, right? You can see that there. I kind of devised it in that way. But you can see that despite the fact that both companies had the same growth rate, despite the fact that both companies had the same year five net income, the same profit by year five, um, one company had better ROIC than the other. And what does this mean? It means that on the balance sheet, the cash that each company generated is going to look a little bit different. Let's say we started off with $100 in cash. And assuming that this is exactly what happens here, um, the company's XYZ's cash balance grew to $100.10. Same thing with ABC there. And then you can start to see that there's a little bit of separation now, 132 and $100.21. How are these numbers being calculated? It looks at the difference in the dollar change minus the dollar change of the capital base. So how much more was invested versus how much more was generated in income. So you can see that by year four, XYZ Corporation starts to achieve increasing separation in its cash balance, again, despite identical earnings growth. So by year five, XYZ has more cash on the balance sheet than ABC does. Again, despite the same growth rates. So this is why ROIC is so critical, is because even if there are two companies compounding at the same rate, if one company has better underlying business economics, they're going to have more cash left over, say, the course of 5 years. And that opens up more doors to XYZ than it does for ABC. They have $2, almost $2 of extra capital left over, which allows them to do things like strategic buybacks, M&A, or it allows them to redeploy this capital back into the company. It goes into the capital base, and if they're earning 10% or 11%, then the earnings growth starts to accelerate faster than the other company does. So ROIC can also mean that one company can start to achieve a better compound growth rate than another company, even if they have the same initial trajectory here. So again, the more cash you have left over after your operations are complete, the more options you have as a company to do things that are shareholder friendly, like paying down debt, making an acquisition maybe to increase our earnings growth capacity, um, by paying a dividend, by growing that dividend, by buying back shares, things like that. These are all very shareholder friendly things. And ultimately, what does that mean? It means that all else held equal, XYZ Corporation will achieve better returns for shareholders than ABC. And here you can see the same data visualized. You can see earnings growth is identical over 5 years. But because ABC had to deploy more capital than XYZ over time, XYZ has the better ROIC, which means that they will have an increasing cash balance relative to ABC. This is a mathematical certainty. So again, two businesses growing at exactly the same rate can have very different outcomes in 5, 10, and even 15 years. So the takeaway, growth is definitely important, not saying that it's not. This is the dual engine of investment returns, growth and ROIC together, not growth in isolation and not ROIC in isolation either. You want to see a overlap of both. Growth is important, but ROIC is equally important as it tells you how much capital is required to generate said growth. So the little screen that beats the market uses just three criteria. We're looking for S&P 500 membership. So that's step number one. Then I look for the top 30 percentile in terms of change in ROIC. So we're looking for companies that have an increasing ROIC, just like what we saw here in this chart. You see how XYZ started at 10% ROIC, and by year 5, that was almost 11% ROIC. That is exactly what we want to see here. We want to see increasing ROIC, and I'll tell you exactly why in a minute here. So we're picking companies that fall in the top 30 percentile from the 500 in terms of change in ROIC. So we want increasing ROIC over time, meaning the current ROIC minus the 5-year average ROIC. We're looking for that to fall in the top 30 percentile. And then from that group, we want to pick the top 10 percentile in terms of revenue growth predictability. This criteria results in exactly 15 stocks every time, and the rebalance frequency that I had here was every 12 weeks. So the core idea behind this screen is to pick stocks that are not only experiencing strong earnings growth, but increasing capital efficiency, along with highly predictable trend revenue growth. And how exactly is this, achieved? Why? I guess let's ask the question, why? Why would a company get increasing ROIC, right? What's the why behind this or the how behind this? And I'll tell you a couple of the top reasons why a company could get increasing ROIC. Number one, it could be because that there is a favorable product mix, meaning there's more sales from higher margin products or services. Think Amazon, for example, right? We all think of Amazon as the place to order goods, stuff. But AWS is where the highest profit margins come from for Amazon. So Amazon could actually have increasing ROIC if the goods side of the business remains strong, but if AWS gets stronger, meaning if a greater percentage of revenue comes from AWS, then ROIC will improve for Amazon, meaning better margins, which means better net margins, which means better net income, which therefore means better ROIC. So favorable product mix can absolutely tilt ROIC in the right or wrong direction. That's reason number one. Another reason why a company might get increasing ROIC increasing sorry, increasing fixed cost absorption from economies of scale. Think more sales without much incremental cost. This is a hallmark of software companies. If you sell one license of your software versus 10 licenses of your software, there isn't a whole lot difference in cost. Unless if each license comes with a lot of dedicated support, maybe that might increase costs as well. But let's say you're in a type of a industry, a software, company where you don't really see too much incremental cost per license that you sell of your software. So that would mean more revenue without more cost. That means increasing margins again. Again, it also means increasing ROIC. And number three, which is, quite common and quite known, leaner operations. Let's say management implemented a cost review, and they successfully implemented cost cuts, a leaner operation, a more efficient organization, meaning they're still able to generate the same revenue base and growth with less headcount or with fewer equipment or investment. That would also mean increasing ROIC. So see, these are some of the top three. These are kind of the top three reasons why a company would see increasing ROIC. So let's take a look. The performance that I shared last time from 2000 to May of 2025, you can see this is an incredible strategy. Our strategy was up 1204% over that 25-year period. That compares to 629% for the S&P 500. Remember, we're picking within the S&P 500, and that too, we're only picking 15 stocks out of the S&P 500, and these are the results that we've achieved despite that very small subset, a very targeted subset of the S&P that we're picking from. And this is, again, another chart I shared last time back in May of this year. I made this update. So over a more recent time period, a 10-year time frame from 2015 to May of 2025, you can see that the strategy continues to do well even over a 10-year period. Keep in mind, this is a very bull market, time frame here. This was an incredible bull run that we've been in. So this 10-year period really captures a huge portion of the bull market that we've been in now for almost 15 years. Um, and it's remarkable that a strategy that picks within the S&P 500 and that too picks only 15 stocks out of the S&P 500 can beat the market, this soundly on a purely fundamental criteria is impressive. However, not as good in more recent performance. Still good, but it's now a virtual tie. It's kind of had a tough second half of 2025. This is through November 21st of 2025. Here you can see the results here. They're pretty much a dead heat now. So that cushion that we had built up, it has pretty much been competed away, evaporated essentially, because of the incredible momentum of the market. But our strategy still holds its own. I mean, it's not a underperformer, and it's still quite incredible that we can essentially match the incredible bull market that the index has been in on just 15 holdings. So still impressive, I would say, although not as impressive as I presented it back in May. But again, it's primarily because the little screen has struggled in the second half of 2025, but I still think that it remains fiercely competitive with the market despite just 15 holdings and a relatively hands-off 12-week rebalancing period, meaning we just run the screen, buy the stocks, and forget about it until the next 12-week period. After, 12 weeks later, we rerun the screen and buy any new companies and sell any companies that have dropped off. So basically do nothing for 12 weeks. And this is what your performance would have been if you went through that strategy. So again, I'm still very bullish on this. It's a great little screen. You can use this. If you have any questions, I'd love to talk to you more about it. But these are the current holdings. I went ahead and ran it. You can see that within apparel, Cintas Corporation, always a favorite within the apparel sector. Amazon is in here. Decker is currently Universal Health in here. Some other companies that might, be interesting. ServiceNow, always a favorite within the SaaS world. Train has been incredible. Train Tech, they make high-end HVAC units. It's kind of the brand that most homeowners prefer. Train for their HVAC, really top quality stuff. So again, these are the current holdings. I ran them as of today, December 4th. And yeah, if you have any questions, I'd love to talk to you more about it. Please do reach out to us with any questions or comments, 1-866-794-6065, or send us an email to strategycall@zackspro.com. This is a screen that you can plug into your Zacks screener. So if you have a subscription to the Zacks Research System or Zacks Advisor Tools, and you have you have access to the screener, then this is a screen that you can just plug into that screener for you to then be able to run the screen at any time. That way you can keep track of any changes that happen to this list. This is the current list, but again, this can change at any time. They don't change often, but they can change on a moment's notice. So if you would like access to this, please do reach out to us either by phone or email, and I would be happy to send you a copy of the screening criteria that goes into that. All right, sounds good, everybody. Talk to you soon and take care, everybody. Goodbye.